Hi, this is Scott Murray. Welcome to the Daily Economic Market Shout for Thursday, February 16th, 2023. Thanks for joining me today. PPI, stronger, much stronger than expected. But really, what was underneath this number may surprise a lot of people. We saw government goods spending up 2.2%. Yeah, 3% of the index, but it is showing you the fundamental element that's going on right now. We are in literally pushing the accelerator with our fiscal spending. At the same time, we are trying to apply the brakes with the higher interest rates. And so they're creating this cross current in the market. So demand continues to be strong. Remember, we spoke yesterday. We're not that overly enthusiastic about what we saw in the January number. There's a lot of volatility to that. So we take it with a grain of salt, but it is, a better number. And most likely some element of better jobs is helping that. We did see, and we've seen this historically, weaker numbers in December. I think it's more of the numbers distortion than anything else fundamentally going on in the economy. However, we have seen an uptick in prices for the firms. Now, what happened, as we saw through the earnings call, is that didn't really translate. We did see a decline in margin, right? A little bit of deceleration in CPI. Was more than the offset with a little bit higher GDP in the quarter. So we did see some contraction. The strong contraction we're seeing from 8% to 5% from consumer discretionary. Not, surprising given what's going on in that space. Staples, not as much. We lost a point from 7 to 6, but energy popping up did help the overall reading. So there's quite a lot of different veins going on here, but clearly companies are now under more pressure. The earnings that they've been able to appreciate, especially the nominal earnings, as we saw the flow through of inflation there, is mitigating. They are going to have to start thinking about their labor force. Some companies are in great position. They're lean and mean, and they're ready to move forward. At the same time, we have a fair amount of companies that are really struggling. Why is that? It's because of the whole different element of labor this time in the cycle. We've seen a huge increase in intellectual property. It was not in the machinery. It's not in the plants. Where is it? It's in the knowledge of the workforce, and that is moving companies forward, but it's a hit or miss. And so, not surprising to see a movement up, not surprising to see government purchases really leading the PPI higher. And that is cautionary because we can't keep having this very strong demand at the same time we're trying to push down inflation. The good news is the supply chain is healing. We did see supply deliveries improving after 3 years of decreasing, getting slower and slower and slower. So that is telling us, so this little bit of a wave of inflation, probably not particularly meaningful. Yes, inflation's coming down. Market expectations were really low coming this year. Consumers were much higher. We've talked about that dichotomy. And so as the market starts adjusting, bringing it up to where consumers are, we're not surprised to see a little bit of bump in the road moving forward. But demand actually seems pretty good, probably almost too good with what we're getting from the fiscal stimulus. And that will probably encourage the Fed more and more. At some point, the Fed will have to give up on it because they will just distort the financial markets to the point where it is a policy error. They're aware of that. So I think a lot of this is rhetoric on the Fed side, and I think it'll be choppy this year, but I do think we see a path towards lower inflation, which is great, and a stable economy and vibrant growth moving over the long term. This is Scott Murray for the Daily Economic Market Chat. Thanks for joining me.